In 1981, Robert Shiller looked at a chart and asked a rude question. If a stock is worth the cash it will pay in the future, why do stock prices thrash around so violently? Dividends are the cash companies pay to shareholders. They move, but usually not like lightning. Stock prices do move like lightning. They surge, collapse, recover, and overshoot. The old efficient market story said prices should reflect available information. That is useful, but Shiller pushed on the weak spot. If prices are rational forecasts of future cash, then prices should be rough, but not wildly rougher than the cash they are forecasting. Shiller's answer was unsettling. Markets can be extremely hard to beat tomorrow and still be too high or too low over years. That is the Nobel idea. The market may be fast, it may also be wrong. Picture a simple apple tree. The tree gives about the same number of apples each year. One year it gives 100 apples, the next year 102, then 99, then 101. The fruit barely changes. But the auction price of the tree doubles, crashes, and doubles again because buyers keep changing their mood about the future. That is Shiller's puzzle in miniature. The asset is not moving much. The story around the asset is moving a lot. Start with a simple investment question. What is a stock worth? The plain answer is, a stock is worth the future cash it can send back to its owner, adjusted for time and risk. Adjusted for time means a dollar 10 years from now is worth less than a dollar today. Adjusted for risk means an uncertain dollar is worth less than a safe dollar. That idea gives finance its basic present value model. Price today equals expected future cash flows discounted back to today. For a broad stock market, one major cash flow is dividends. If the economy becomes more productive, future dividends should rise. If future profits look weak, future dividends should fall, so prices should move when the outlook for future cash changes. But Shiller asked whether the size of price moves made sense. His famous 1981 American Economic Review paper studied whether U.S. stock prices moved too much to be justified by later changes in dividends. The picture was simple and hard to forget. The price line swung sharply. The line based on later dividends was much smoother. That does not mean prices should never move. It means the market looked like it was reacting to something bigger than future dividends alone. This was not just an academic puzzle. If asset prices can move too far, then households can overpay for homes, retirement savers can buy stocks at poor long-run prices, companies can build during bubbles, and central banks can miss financial danger while inflation looks calm. Shiller's insight was to split two ideas that people often confuse. The first idea is short-run unpredictability. Tomorrow's price move is very hard to forecast because tomorrow's news has not arrived yet. The second idea is long-run valuation. Over several years, an unusually high price relative to dividends or earnings can carry information about future returns. Those two ideas can both be true. In plain English, you may not know whether the market goes up next week, but you can still know when investors are paying an unusually high price for each dollar of long-run cash. This is where Shiller challenged the simple version of market efficiency. An efficient market is a market where public information is quickly reflected in price. Shiller did not deny that markets can be fast. He showed that fast does not always mean right. The mechanism is expectation. A price contains a forecast about the future. If investors become more optimistic, they may pay more for the same stream of cash. If they become fearful, they may pay less. Those changes can be rational if risk truly changes. They can also reflect waves of belief, stories, leverage, and social imitation. Shiller's work opened the door to behavioral finance, which studies how real people make financial decisions when they have emotion, limited attention, stories, and social pressure. Behavioral does not mean stupid, it means human. The clean mechanism starts with the present value equation. P sub T equals the expected future dividends, discounted for time and risk. POA means today's price, D means future dividends, EWA-T means the expectation formed using information available today. Discounted means future payments are reduced because they arrive later and are risky. If this model is doing most of the work, then a big price increase should usually come from one of three sources. First, expected future dividends rose. Second, investors became willing to accept a lower future return. Third, the risk of owning the asset changed. Shiller's evidence made the first answer look too small. Dividends were not moving enough to explain the price swings. That leaves the hard part. Maybe discount rates and risk attitudes move a lot. A discount rate is the return investors demand before they will hold a risky asset. When fear is high, investors demand more return, so today's price falls. When confidence is high, they demand less return, so today's price rises. But Shiller also made room for a more human story. People do not price assets in silence. They copy, compare, narrate, and extrapolate. Extrapolate means they take a recent trend and imagine it continuing. A market that has gone up can create a story that it must keep going up. That story attracts new buyers, which pushes the price higher, which makes the story feel true. That loop is the bubble mechanism. Higher price leads to a stronger story. A stronger story brings in more buyers. More buyers push the price higher again. The loop can run in reverse. Falling price leads to a broken story. A broken story can force selling. Forced selling can push the price lower again. Shiller's special contribution was not merely saying bubbles exist. Many people had said that. His contribution was empirical discipline. Compare prices to later cash flows, test long-horizon predictability, and ask whether the swings can be reconciled with a rational model. The Nobel materials describe the key finding clearly. Fama showed short-run prediction is very hard. Shiller showed that over longer periods, prices can be forecast in broad terms because high price-to-dividend ratios tend to be followed by lower future returns, and low ratios tend to be followed by higher future returns. Price-to-dividend is simple. It asks how many dollars investors pay for $1 of dividends. A high ratio means investors are paying a lot for current cash. That can be justified by high expected growth. It can also signal over-optimism. Shiller's 1981 paper became famous for the excess volatility picture. The stock price line moved much more than the later dividend-based value line. Later work with John Campbell linked prices, earnings, dividends, and expected returns. Earnings are company profits. A cyclically adjusted earnings measure smooths 10 years of inflation-adjusted earnings, so one boom or recession does not dominate the signal. That idea became known as CAPE, or the cyclically adjusted price-earnings ratio. CAPE is not a daily trading rule. It is a long-horizon warning light. When investors pay unusually high prices for smoothed earnings, future long-run returns have often been lower. When they pay unusually low prices, future long-run returns have often been higher. Shiller's public career gave the idea force because it met reality twice. In 2000, his book Irrational Exuberance appeared near the peak of the dot-com bubble. The title captured a market mood where technology stories were often priced as if disappointment had been abolished. In the 2000s, Shiller and Carl Case helped build repeat sales housing indexes, which compare sale prices of the same homes over time. The Case-Shiller indexes made housing prices visible as a national market signal. Before the financial crisis, that signal showed a housing boom that looked less like steady fundamentals and more like speculative heat. The point is not that Shiller timed every top. Nobody does. The point is that valuation and narrative can diagnose danger before daily prices admit it. The wall is that Shiller's idea is powerful but easy to misuse. First, valuation is not timing. A market can be expensive and keep rising. A home market can look stretched and stay stretched. A bubble can punish skeptics for years before it breaks. Second, fundamentals are not perfectly observable. Dividends change. Buybacks replace some dividends. Accounting rules shift. Interest rates can stay low. Global savings can change the return investors demand. Third, a high price may reflect low expected future returns rather than irrationality. That is still important, but it is a different diagnosis. It says investors may be accepting a lower return, not necessarily making a mistake. Fourth, the market can be wrong and still hard to short. Shorting means betting against a price. To short a bubble, you need capital, patience, risk limits, and clients who will not fire you before the bubble breaks. This is why Shiller is not the opposite of FAMA. FAMA says obvious public trades are hard to exploit quickly. Shiller says broad market prices can still become too enthusiastic or too depressed over time. Together, they create a better rule: respect price in the short run, interrogate price in the long run. For investors, Shiller's lesson is not sell whenever CAPA is high. The lesson is to make valuation part of risk management. If prices are very high relative to long-run cash, expect lower future returns, wider disappointment risk, and more sensitivity to bad news. That may mean saving more, rebalancing more carefully, reducing leverage, or diversifying across regions and assets. Leverage means borrowed money. It makes good outcomes better and bad outcomes faster. In a Shiller world, leverage is dangerous when it is attached to a popular story. For homeowners, the lesson is not that homes are bad investments, it is that a house is both shelter and an asset. If people begin buying because they believe prices can only rise, the shelter decision has become a speculative trade. For companies, the lesson is that market signals can mislead capital allocation. A high stock price can make expansion feel safe. Cheap debt can make every project look fundable. Bubble prices can pull real factories, workers, and loans into the wrong places. For policymakers, the lesson is that financial stability cannot be outsourced to the idea that markets know best. Prices contain information, but they can also contain contagion. A contagious story is a belief that spreads because people see others believing it. The practical tool is not arrogance, it is structured doubt. Ask 4 questions. What cash flow justifies this price? What story is making people willing to pay it? What would prove the story wrong? Who is forced to sell if the story breaks? Those questions are Shiller's Nobel Edge. Shiller taught finance that price is a forecast, not a fact. A market can process news quickly and still carry a long-run mistake. The investor's job is not to shout that the market is irrational. It is to separate cash flow from story, respect timing risk, and avoid paying any price for a beautiful narrative.